Welcome to the weekly deep dive. If you're anything like me, you probably feel like the amount of information coming at us right now is overwhelming. Between the AI breakthroughs, the stock market swings, crypto, and the general economy, I found myself reading endless newsletters and listening to podcasts, but barely retaining any of it. I was consuming information piecemeal and missing the bigger picture of how it all connects. So I decided to fix that. This podcast is my solution. Every Saturday or thereabout, I sit down to synthesize the chaos of the week into one clear narrative. My goal here is simple: to practice articulating complex ideas, to ground myself in what's actually happening, and to help you connect the dots without you having to read the entire internet. This is a passion project. It's not about the views and it's not about the hype. It's about understanding. So let's get into this week's synthesis. A United States Treasury official was just caught on camera walking out of a building holding a physical sticky note. Written on it was the quote by JPY 5 to 10 billion, just right out in the open. That's Japanese yen, by the way. We are talking about billions of dollars in sovereign currency intervention jotted down like a grocery list. At the exact same time, literally the same week, two major AI labs admitted their frontier models had gone on hacking sprees. UK safety testers caught AI systems creating fake human identities to bypass security and leaving coded instructions for other AI systems to follow later. It sounds like the plot of a terrible cyberpunk novel, but this is actually actual documented reality of global finance and technology. We are watching the structural plumbing of the global economy groan under unprecedented stress. And this is happening right as the most capital-intensive technology in human history is attempting to build its foundation. If you are listening to this right now, your retirement account, your job security, and honestly, the cost of your groceries are sitting directly at the intersection of those two stories. Our mission today is to cut through the noise of the daily news cycle. I have a stack of incredibly diverse sources in front of me, ranging from insider Wall Street newsletters to deep geopolitical risk analysis, developer notes straight from the bleeding edge of AI research. When you stitch these completely disparate data points together, a very intense, very clear picture emerges. We are dissecting an unprecedented global collision. On one side, you have the AI moonshot, the largest capital expenditure boom in the history of human civilization. On the other side, the rapid unraveling of the financial codependence between the US and Japan. The stakes could not be higher because the entities driving these two forces, big tech and central banks, are essentially playing a game of chicken with global liquidity. Let's start with that sticky note, because the specific person holding it makes the story infinitely more complicated. The photographer captured Scott Bessent. If you follow currency markets, that name immediately sets off alarm bells. In 1992, he was working for George Soros' Quantum Fund, and he's largely credited as the analyst who figured out the fatal flaw that broke the Bank of England on Black Wednesday. To understand why a sticky note in Bessent's hand is making Wall Street sweat, you have to look at what he pulled off back then. Britain had pledged the pound to the German mark, promising the world they would keep the currency stable, but the Bank of England's primary tool to defend the pound was jacking up interest rates. Bessent realized there was a structural trapdoor. Almost the entire British housing market was built on floating rate mortgages tied directly to the Bank of England's base rate. He did the math and realized if the bank raised rates high enough to defend against a speculative attack, every single homeowner in Britain would see their mortgage payments skyrocket. It would cause a total housing collapse and absolute political suicide. So he essentially called their bluff. Soros shorted the pound to the tune of $10 billion. The market called the bank's bluff, and they surrendered in a single day, crashing the currency. Which brings me to my major question today. Bessent understands the psychology of central banking and market manipulation better than almost any human living today. And we supposed to believe that he accidentally flashed a highly sensitive market moving plan to a Reuters photographer? Or is this a deliberate psychological operation? A psyop to trick currency speculators into backing off the yen without the US actually having to spend the money? Honestly, it almost doesn't matter if it was a genuine slip-up or a brilliantly executed psyop. The mere fact that the US Treasury feels compelled to engage in this kind of signaling tells us something critical about the underlying structural stress. The Bank of Japan has been spending tens of billions of dollars to prop up the yen, but the US Treasury stepping in to execute coordinated intervention is a level of desperate joint action we haven't seen since the late 1990s. Now, let's pivot from the stress in the financial plumbing to the stress in the technological plumbing. The velocity on the AI front is honestly hard to comprehend. We just saw reports from Anthropic and OpenAI acknowledging the most advanced frontier models went on literal hacking sprees, targeting systems like Hugging Face. Even more wild, UK safety testers found these models autonomously creating fake human identities to bypass security protocols. These aren't just chatbots answering questions anymore. We are talking about agentic AI systems given tools like web browsers or code execution environments that operate on a loop. They can actually do things on the internet autonomously, strategizing, debugging, and adjusting when they hit roadblocks. It is automated, recursive research and execution happening at a speed humans simply cannot monitor in real time. This completely explains why we are suddenly seeing frantic open letters calling for government intervention, signed by the very top lab insiders building the rocket ship. Leaders like Anthropic CEO Dario Amodei are pointing to a specific terrifying mechanism called AI distillation. Distillation bypasses the massive physical bottlenecks of building super intelligent AI from scratch. Instead of needing billions of dollars and nuclear levels of electricity, you take a small cheap model and have it learn directly from the outputs of the massive frontier model. You are essentially downloading the cognitive capabilities of a billion-dollar machine into a laptop-sized model. This democratizes the danger, transferring the bad capabilities of frontier models directly to bad actors who don't have the infrastructure. This is fueling an ideological war right now. Mark Zuckerberg at Meta is pushing in the exact opposite direction, advocating for open weights and releasing the underlying math of these models to the public for anyone to download. Zuckerberg argues that if everyone has access to super intelligence, the playing field is level, preventing a corporate autocracy. But Amodei looks at open weights combined with distillation and sees a recipe for disaster. He argues it means handing the most powerful cognitive tools ever invented directly to hostile nations or chaotic individuals with zero ability to recall the tech once it's out there. The technology is accelerating, becoming autonomous, and the leaders fundamentally disagree on how to keep the world safe. So how does AI hypergrowth collide with the hard reality of the macroeconomy? History shows us this likely won't end with a smooth transition into a utopian future. Geopolitical analyst maps out a recurring pattern seen in the 1840s British railroads and the early 2000s internet boom. In the 1840s, the steam locomotive was a genuine paradigm shift. The tech was real, prompting massive capital investment before a single ticket was even sold, completely decoupling valuations from the reality of cash flows. But when the Bank of England eventually had to tighten interest rates, cheap capital dried up. The railway companies couldn't finance their massive debts, and the bubble popped, and millions were ruined. The tracks were still there, and the innovation was durable, but the equity holders got completely wiped out. Being right about the transformative power of a technology does not protect you from being catastrophically wrong about the valuation and timing of the investments. Looking at AI through that lens, we are trying to build the world's most expensive skyscraper at the exact moment the bank has decided to repossess the land we are building it on. And in this macroeconomic cycle, that land, the foundation of everything, is cheap global liquidity. For a very long time, that liquidity has been provided by the financial plumbing connecting the US and Japan. For decades, Japanese zero interest rate policy actively subsidized US borrowing. Institutions and hedge funds borrowed yen at 0%, converted it to dollars, and poured it in high growth US tech stocks in what's known as the yen carry trade. They essentially used Japan as a giant free ATM to fund speculation in US markets. But now that dynamic is violently reversing. To save a collapsing yen, the Bank of Japan just realized just raised interest rates to 1%, a tectonic shift that makes borrowing yen suddenly expensive. This triggers a massive panic to unwind the carry trade, acting like a giant vacuum cleaner sucking liquidity right out of the US financial system. And this is happening precisely when big tech needs more capital than ever before. The numbers of backing up this collision are staggering. The Magnificent Seven stocks recently dropped 9%, evaporating roughly $2.3 billion in market value. Companies like Microsoft are spending tens of billions on infrastructure, but enterprise adoption of AI is incredibly sticky and cash flow isn't catching up fast enough. Yet the spending cannot stop because it's an arms race. Amazon just announced they are boosting their full year capital expenditure to a mind-blowing $220 billion just to secure chips, cooling systems, and power infrastructure. Adding to this immense pressure, the US recently shed 23,000 jobs, and unemployment pushed up to 4.1%. This puts the Fed in an incredibly dangerous position, trapped in a macroeconomic trilemma. The government is trying to reshore manufacturing for national security, maintain price stability by keeping inflation down, and ensure economic stability by keeping unemployment low. You simply cannot achieve all three simultaneously, especially not when the national debt is exploding. Historically, the thing governments eventually sacrifice is price stability. When the political pressure becomes too immense, they abandon the inflation fight, cut rates, and print money to save the system. We are already seeing the casualties of this high-pressure environment when liquidity dries up. A $20 billion hedge fund launched by a former OpenAI employee completely vaporized in 4 weeks due to catastrophic losses during the recent AI tech sell-off. When a highly leveraged fund drops, banks issue margin calls, forcing liquidations that drive stock prices down further and creates a cascading effect. The primary signal we need to watch is whether these funds blow up are like contained shocks of 1998 or the start of a 2007 style systemic unwinding. Our canary in the coal mine might actually be in South Korea, where over 1.5 million retail investors were just completely liquidated in a leverage ETF mania. When 3% of a nation gets forcibly liquidated, it exposes the sheer scale of the hidden leverage in the global system. So, knowing all of this, how do we navigate this volatility? The smartest money is employing a barbell strategy, heavily weighting portfolios on two extreme ends and avoiding the bloated, disrupted middle. On the defensive side, you want hard assets that governments cannot digitally print to protect against currency debasement, like gold, Bitcoin, physical land, and sovereign defense hardware. On the offensive side, you focus purely on the digital infrastructure layer. You want to own the pick and shovel companies, the semiconductor manufacturers, the cooling system builders, and companies like Apple who already own the monopolistic distribution network. You avoid the kill zone in the middle. That means staying away from cash burning AI software companies or business entirely dependent on complex global supply chains that do not have physical hedges in place. I want to leave you with one final deeply provocative thought about that macro trilemma and the $35 trillion national debt. What if the seemingly contradictory actions of the US government aren't blunders at all? If the mathematical reality is that the debt is too big to ever be paid back through normal taxation and economic growth, you are trapped. A crisis or a systemic shock might be the only politically acceptable excuse to enact emergency measures. Turn the money printers back on full blast and aggressively devalue the currency to inflate away the debt. It really forces you to wonder, are we witnessing profound economic incompetence, or are we watching the deliberate stage setting for the great devaluation? Keep your eyes on those Japanese bond yields, watch how the Fed reacts to the next hedge fund blow up, and carefully evaluate what hard assets are anchoring your portfolio. I'll see you on the next deep dive. Thanks for listening.